The Monetary Policy Committee has decided to keep interest rates unchanged, with the repurchase rate remaining steady at 7%. Reserve Bank Governor Lesetja Kganyago announced the decision earlier today, citing current economic conditions and inflation trends as key factors behind the move.
Against this backdrop, the MPC decided to keep the policy rate unchanged at 7%. 4 members preferred to keep rates on hold, while 2 favored a cut of 25 basis points. Since September last year, we have reduced rates by 125 basis points, and we want to see how this is affecting the economy, how expectations evolve, and how inflation risks are resolved. The forecast has rates easing gradually as inflation returns to the bottom end of the 3 to 6% target range.
Right, let's bring in Khaya Sithole, who's an independent analyst. He joins us now live. Khaya, very good evening to you. Thank you for your time. The MPC having decided to hold the repo rate at 7%. From an economic perspective, what is the main reasoning behind keeping rates unchanged for now?
Good evening, and good evening to your listeners. So essentially, in its decision-making process, what the MPC considers are a range of factors based on obviously the data that they would have collected up until the point in time when they start their meeting, and also what their forecasts are telling them about what is likely to happen in some of the key economic fundamentals. And it is that confluence of different factors that they consider and then collectively take a view on where they think the interest rate number should be. And I think in putting all of this together, they obviously have to consider a lot of unpredictable factors. And I think in this particular year, we've obviously seen the impact of these exogenous tariff wars in particular, which has forced every single reserve bank or every single central bank to try and factor in what the possible effects on their economies might be, and then make a call on where they think it's going to be. So it's never an easy decision, and ultimately what we hear today is a sum of consideration of multiple and sometimes often contradictory pull and push factors that influence that decision making.
So in assessing that impact, what does it essentially mean, the decision to immediately for households and with debt and businesses needing credit, what does this mean?
So naturally, for those that already have debt exposure and those already have got credit exposure, it means that whatever their payment rates or whatever their payment costs were are likely to stay the same in the interim. And obviously what everybody always wishes is for a reduction in those rates in order for them to be paying less towards their debt. But also keep in mind that the Reserve Bank has to consider both sides of the equation. So they don't only focus on those that have got credit exposure, they also focus on those that are saving money. So therefore, when you look at what the interest rate does, is that it actually serves both those that are saving, who obviously want the value of their savings to grow, and also those that have credit exposure, who obviously want it to be as cheap or as low as possible. So it's in that trade-off where they obviously have to find a number that they believe represents the best of those multiple trade-offs. So those that already have credit exposure, obviously the hope is that ultimately interest rates will be lowered. And obviously in the past year, we've seen them gradually coming down, but obviously any number above 0% as an interest rate cost, if you're paying interest, is probably too high anyway.
Yeah, with the consideration of, a very fragile and gentle balancing act, inflation, we know, is expected to average 3.4% this year, only slightly above the bank's new 3% target. Should the Reserve Bank be more aggressive in cutting rates to stimulate growth? What are the finer details of this balancing act?
Well, the difficulty is that firstly, for a very long time, we've been working on the basis of the range of 3 to 6%. And the conversation around whether there should be a new number or whether there should even be an absolute number, that's an ongoing conversation that the Reserve Bank and National Treasury are still deliberating on. But ultimately, whichever way they decide to go in that conversation is going to have significant implications for how they then manage future announcements and future, inflation and interest rate expectations. So it's not a finalized conversation yet. But naturally, what everybody wishes to find is a simple way of saying, can we make the cost of borrowing low enough to stimulate additional economic activity? So perhaps if people were planning on opening new businesses and then they look at the cost of financing, and that becomes a decisive factor that says perhaps not at this time. These are the people that are then looking at the future outlook and then saying, well, perhaps if interest rates were a few basis points lower, then the investment decision is made easier. So we always need to try and figure out whether we can be able to gradually move towards cheaper borrowing costs, because that might indeed swing the pendulum towards a bit more economic activity being injected, either people opening up businesses or people investing in assets that they otherwise would be holding back on the basis of what the interest rate cycle is telling them.
Khaya, then how does one weigh the positive GDP growth data against the ongoing cost of living crisis that many South Africans face on a day-to-day?
So the important thing about economic data points is that they all tend to extract particular data points for a specific purpose. So when we look at the GDP data that we've seen in recent weeks in particular, it simply then says that, look, over the past quarter, this is what the momentum of economic activity has been indicating, has been showing us. When you look at unemployment data, for example, it then tests a different matrix of the economic environment. And collectively, they obviously give us a full spectrum of what the economic conditions are at any particular point in time. But it's also quite important to understand that even within an inflation universe where inflation is not as high as it could have been in the past, there could be parts of the economy where the inflation is much higher. So if we look at electricity inflation, for example, that might be much higher than general inflation, which means that given how ubiquitous energy prices tend to be, it then actually affects a lot of people and a lot of businesses that are trying to find their way through the economy. So there's always many more granular details that one has to understand before making a call on what needs to be done. But I think ultimately we all agree that cheaper borrowing costs are a better way to go.
Yeah.
All agree that higher GDP growth is the way to go, and we all agree that lower inflation is where we need to be. But a lot of this is subject to exogenous factors that very few, where we have very few instruments of intervention, or at least proactive intervention as a country.
Absolutely. Thank you so much for weighing in on the discussion. Khaya Sithole, an independent analysis there, giving us some feedback looking at the repo rate, which has remained unchanged.